All right, let's get right into it. Today, we are doing a technical deep dive into the tax rules for health savings accounts and medical expense deductions. We're going to go straight to the source, the Internal Revenue Code, to see how these incredibly powerful tools actually work and, more importantly, how you can use them correctly and stay out of trouble.
Okay, so here's our game plan. First, we're going to build the foundation by looking at what the IRS even considers medical care. Then we'll talk about the vehicle itself, the health savings account, or HSA. After that, we'll see how those two things intersect. This is a critical step. Then we'll get practical. How do you report all this on your taxes? And finally, we'll cover what might be the most important piece of the puzzle, what you need to do to prove you followed all the rules. So let's start at the beginning with the absolute bedrock for all medical tax benefits, Internal Revenue Code Section 213. Now, this section is famous for the itemized deduction for medical expenses, but its real power is that it gives us the core definition of medical care that applies to pretty much every health-related tax account out there. Now, pay close attention to this definition because this single sentence is the gold standard. It's not just for people itemizing deductions on Schedule A. This exact phrasing is what governs HSAs, it governs FSAs, it even governs HRAs. Seriously, this is the one definition to rule them all. Okay, but when it comes to itemizing those deductions using Section 213, there's a huge catch. The rule sets a pretty high bar. You can only deduct the portion of your medical expenses that is more than 7.5% of your adjusted gross income, your AGI. So what does that mean in reality? It means for most people, this specific deduction is only going to come into play in years where you have some truly significant medical bills. And this is where the IRS draws a very clear line in the sand. They're specific. An expense has to be for treating or preventing a specific physical or mental illness. Things that are just good for your general well-being, like a gym membership, vitamins you weren't prescribed, or taking a relaxing vacation, sorry, those aren't going to cut it. It has to be targeted medical care. So now that we have a crystal clear understanding of what medical care is, let's talk about the best vehicle for paying for it, the Health Savings Account, or HSA. This is the tax-favored account specifically created by Internal Revenue Code Section 223. And here, my friends, is where the magic of the HSA really kicks in. Section 223 says that when you take money out of your HSA for a qualified medical expense, that distribution is completely 100% tax-free. And remember that 7.5% AGI floor we just talked about? Well, with an HSA, it's gone. It doesn't apply. You get a tax break on the very first dollar you spend. And here it is. This is where it all ties together. How does the law for HSAs define a qualified medical expense? Well, it doesn't create a new definition. It points directly back to the one we just learned in Section 213. This creates an unbreakable, direct link between the two parts of the tax code. If it counts as medical care for one, it counts for the other. Simple as that. Now, you really don't want to mess this up because the penalty for misuse is severe. If you take money from your HSA for something that isn't a qualified medical expense, that amount is taxable as income. But that's not all. On top of that, IRC Section 223 hits you with this 20% additional tax. To put that in perspective, that's double the 10% penalty for an early withdrawal from a traditional IRA. The IRS is not playing around here. But the code does provide a few crucial escape hatches from that nasty 20% penalty. It gets waived if the account owner passes away, becomes permanently disabled, or, and this is a huge one, reaches age 65. After you turn 65, your HSA basically gets a superpower. You can take money out for any reason at all, and while you'll still pay regular income tax on it, that extra 20% penalty completely disappears. It effectively transforms into a traditional retirement account. Okay, so we've got the definition of medical care from Section 213, and we've got the tax-free way to pay for it with an HSA under Section 223. Now let's zoom in on a critical rule that prevents anyone from getting a double tax benefit. Think of it this way. For any given medical bill, you have to pick a lane. You can either pay for it tax-free out of your HSA, or you can include it as part of your itemized medical deductions on Schedule A. What you absolutely cannot do is both. The law is explicit, no double dipping. You can't get a tax break twice for the exact same expense. And this isn't just a suggestion, it is written right into the law. Here's the precise legal authority from IRC Section 233 F6.
It says that any money paid out of an HSA for qualified medical expenses shall not be treated as an expense paid for medical care when you're figuring out your itemized deduction. In plain English, you can't count it twice. End of story. Okay, so we've got all this theory down. How does it actually translate to your tax return? Well, it all comes down to a single, very important form. Form 8889, the health savings account form you file with your 1040. This form is your annual check-in with the IRS for your HSA. You have to file it in any year you contribute to your HSA or, more importantly for our discussion, take any money out. This is where you reconcile everything and prove that your distributions were used properly. Now, Part 2 of this form is really the heart of distribution reporting, and it's basically just a simple subtraction problem. You start on line 14A with the total distributions your HSA custodian reported on Form 1099 essay. Then, on line 15, you enter the amount you actually spent on qualified medical expenses. The difference, which goes on line 16, is your taxable amount. And if there is a taxable amount, line 17A is where that 20% penalty gets calculated. Now, Part 3 deals with a few more complex, special situations. For example, there are specific rules if you use the last month rule to make a full-year contribution, but then fail to stay eligible for the next year, or if you do a one-time transfer from an IRA to your HSA. If you mess up these special rules, you can get hit with what's called a recapture tax, which is basically the IRS taking back a tax break they gave you earlier. So this is a super important distinction to understand. Form 8889 can hit you with two different penalty rates. That steep 20% additional tax applies to your regular non-qualified distributions from Part 2. But the penalty for one of those testing period failures in Part 3 is a 10% additional tax. It's absolutely crucial to know which penalty applies to which compliance failure. Okay, we've covered the rules, we've covered the reporting, but what happens if the IRS decides to take a closer look at your Form 8889? This brings us to our final, and I would argue the most important section of all, the burden of proof. And let me be perfectly clear, there is zero gray area here. The regulations are unforgiving. If you get audited, the responsibility is 100% on you, the taxpayer, to prove that every single dollar you claimed on line 15 of Form 8889 was spent on a legitimate, qualified medical expense. The IRS is very specific about the kind of records you need. And remember, your HSA custodian, the bank or financial institution holding your money, they don't police your spending. They aren't checking your receipts. They just report the total amount you took out. Proving what it was for is completely and entirely up to you. Now, the IRS isn't totally heartless. They do provide a way to fix a genuine mistake. If you accidentally take money out for a non-qualified expense, you can repay it. But notice the standard of proof here. You need clear and convincing evidence that it was a reasonable mistake. That is a very high legal bar to clear. This isn't a get-out-of-jail-free card for sloppy record keeping. So here's the ultimate takeaway. HSA compliance isn't just about knowing the rules at the moment you swipe your debit card. It's about maintaining detailed, organized, contemporaneous records so that you can prove you followed the rules, potentially years after the transaction actually happened. And that really brings us to the critical question every single person with an HSA should be asking themselves. Are your records audit-proof? Because at the end of the day, when it comes to taxes, they are your one and only defense. Thank you for joining this deep dive.